Share sale agreements. Welcome to this 30-minute webinar on share sale agreements. This is Leigh Adams, and I will be spending about 15 minutes on tax issues in share sale agreements. And Stephen Groves of Groves and Partners will spend about 15 minutes on valuing intangible assets. So without further ado, let's begin. Tax issues in share sale agreements. Of course, share sale agreements are very common in the SME arena. When disposing of assets held by a company, it is often either done by a sale by the company of its business or by a share sale. However, for the sale of business, there are two taxing points, whereas for the sale of shares, there's generally only one taxing point. And so share sale agreements are frequently more popular, and hence this discussion. In fact, in this webinar, we focus on two key areas which rightly occupy a significant focus for buyers and sellers alike. Let's look at the difference between a tax indemnity and a covenant to pay. Should you have a tax indemnity or should you have a covenant to pay? Is there a difference between them? Or should you just have some other form of price adjustment mechanism? Well, a tax indemnity is an enforceable contract or a clause in an enforceable contract to hold someone harmless against loss, all loss. However, most so-called tax indemnities are in reality just a covenant to pay. That is, a price adjustment mechanism by which the amount to pay by the purchaser is dependent upon the tax payable by the target company. So most indemnities do not extend to all losses arising out of the non-payment of tax. How do you trigger the entitlement to recover? If the clause is drafted as to apply to any tax payable, then the tax liability does not have to crystallise before the covenant to pay arises. But if the clause only applies in the context of an amount arising under a tax assessment, then liability does have to crystallise before the obligation to pay arises. Let's look at tax indemnities. They are an efficient way for the seller to put the buyer into funds in respect of tax liabilities. A tax indemnity usually relates to a period before completion, that is, prior to when the buyer began to control the company. But what if the buyer already owns some of the company, some part of the company? Well, in that case, the indemnity might relate to another period. For example, the relevant period could run from when the risk and reward of the company passes to the buyer. Does the indemnity cover acts, events, and transactions before completion? This is not uncommon, and particularly so if such actions can give rise to taxes payable after completion. With tax indemnities, who is the indemnifying party? Typically, of course, this is the seller. But what about if the company is part of a tax consolidated group? In this case, it is the head company which is responsible for paying the tax liabilities of the subject company. Section 701 of the ITAA 1997 provides for this. And if they fail to pay, then the commissioner may pursue the other group members, subject to the existence of an appropriate tax sharing arrangement. See section 701 of the ITAA 1997. However, rather than leaving it up to the commissioner, you may cause a clause to be inserted, or you may request at least a tax indemnity from the ultimate owner, but that's unusual and ask and don't get, and so lots of luck with that. What are the exceptions to tax indemnities? When should they not apply? Well, they should not apply firstly where the buyer fails to lodge tax returns. Another example of where they should not apply is where the buyer fails to lodge an objection or where the buyer fails to claim a refund. If, for example, $200 worth of taxes were due pre-completion, but the company was entitled to claim a refund of that $200, then the seller likely would argue that they should not be required to pay out that amount. Generally, the seller will say that its liability will only extend to matters which were within its control. Another example of where tax indemnities should not apply is if the buyer takes a position inconsistent with that of the seller in relation to tax issues. A further example could be that a tax liability would not apply is where they've already been paid, of course. This is an obvious exception, but if it is yet to be paid, and on that assumption it is taken into account when determining the purchase price, then it should not form part of the indemnity, as the buyer would be getting its benefit twice. Firstly, as a reduction in the purchase price, and then of course again once the tax indemnity applies. So what time limits apply to tax indemnities? Does the indemnity expire before the end of the review period for the applicable tax return? It might, so make sure that it does not. What about transfer pricing issues? Now, by transfer pricing, we mean the price that is paid for goods and services transferred from one part of an organisation to its other parts. So, where transfer pricing could be an issue, generally you need to allow at least 7 years for the tax indemnity to operate. And that 7-year period should commence from the time that the Commissioner gives notice of the assessment to the company. Section 815 of the ITAA 97 provides for that. Let's now turn to tax warranties, tax warranties. These are contractual claims, so you have to show a breach of the warranty as well as loss and thirdly, mitigation of any damage. Breach of an indemnity, on the other hand, gives rise to a claim with no obligation to prove damage or to mitigate loss. Moreover, recovery under an indemnity can be far wider than under a breach of warranty. There are two types of tax warranties, generally speaking. The first is an information gathering tax warranty circumstance, information gathering up to completion. For example, taxes that the company is liable to pay from date X up to completion. Such a warranty allows the buyer to price the company's shares appropriately. Also, this clause can give the buyer the comfort of knowing that any claim under the tax indemnity clause will be unlikely to breach the tax indemnity cap. The second type of tax warranty is a warranty covering tax liabilities arising in the future. For example, a warranty made regarding agreements with a tax authority for future tax payments. For example, agreements to pay past unpaid taxes. We turn now to the interaction between tax warranties and warranty and indemnity insurance. W&I insurance covers warranty breaches and or breaches of indemnity. And of course, the buyer should avoid clauses limiting recovery against the seller to the amount received from their insurer. The reason being, of course, as we all know, insurers can fail to pay out for all sorts of reasons. So what are the workarounds for W&I insurance? There are two usually. Either you agree on the W&I insurance limitations so that the seller agrees to pay what the insurance company does not pay, or alternatively, you agree on separate provisions for specific issues not covered in the W&I insurance. An example of this could be transfer pricing, and you have a separate tax indemnity provision for any problems arising out of transfer pricing issues. Who should have control of tax matters? For tax returns, usually the seller has control for periods ending before completion. But for periods which start before completion and which end after completion or at completion, usually the buyer is responsible for these lodgements. Who has the review rights? Typically, the non-lodging party can have the review rights. They typically have a right to appoint an independent tax advisor to help them. What about tax disputes? Who controls the conduct of a tax dispute with the ATO? Well, a well-drafted agreement will state who is to control this and what approvals they will need before they can settle or compromise the dispute. Can you use a third-party claims clause? Yes, and often people do. You can often have use of a third-party claims clause and include the tax disputes within it. What about step-in rights for a buyer? Do they work? Yes, very frequently they exist and very frequently they do work properly. Often such a clause allows the buyer to step in and take over the management of the dispute. But if you step in, then you will usually lose your rights to rely on your tax indemnity clause. Now, under the umbrella of who should have control of tax matters, let's look at completion and conduct pending completion. Often the seller is restricted in a number of ways in what they can do before completion. There is usually a provision that the seller must not settle or compromise any tax dispute and that the seller must not pay any dividends unless otherwise permitted. Of course, that begs the question, what dividends are usually allowed before completion? Well, you could limit dividends paid before completion by requiring dividends to be paid from cash or by stipulating that they do not breach any benchmarking franking rules and that they do not cause a franking deficit. What other controls of pre-completion should there be? Restricting the buyer from engaging with revenue authorities is a common provision. But a rookie mistake would be not to consider how this impacts upon the pre-completion matters and third-party claims clauses. Another issue relating to control of tax matters at pre-completion is ensuring an easy exit if the company is part of a consolidated group. For example, the company may have a liability for tax contributions under a tax sharing agreement for the group from which it is exiting. You need to draft clear exit provisions in that case, and these can require the seller to provide that the amount required to achieve a clear exit has been calculated and to the extent necessary it has been paid. Let's take a look at consideration. Cash is king. Most payments are generally cash, and I include EFTs in this, and most payments will generally be capital proceeds for the seller, and section 116 of the ITAA 97 deals with this. But what about pre-completion dividends or earn-out provisions? Different considerations apply here, so beware. Considerations can also be by way of exchanging script and using the CGT rollover provisions. What are the issues here? Well, firstly, the replacement interest must be in the buyer or in the ultimate holding company. Secondly, the buyer must become at least an 80% owner in the target company. Thirdly, you must set out the number of shares each seller is to receive. And finally, how do you deal with the completion statement or claims? Do you adjust by way of cash or additional script? This needs to be thought through. Now, turning to the foreign resident capital gains tax withholding provisions, this applies to vendors disposing of certain taxable property on or after the 1st of July 2016. Under the legislation, the purchaser has to remit 12.5% of the purchase price to the ATO. This can be avoided by, begin quote, Australian resident vendors, end quote, lodging a declaration with the ATO. There are two approaches to this. You can insert the declaration within the sales agreement, or alternatively, you can use the ATO form and, providing the declaration is in writing and complies with Section 14 of Schedule 1 of the Taxation Administration Act 1953, either approach is fine. Remember that if the seller is a trust, then it is the trustee of the trust that must provide the declaration. Other issues also arise, such as whether you need a declaration or a clearance certificate, where I should say some of the assets are real estate and some are shares. Sometimes both a clearance certificate and a declaration are required. Now, let's look briefly at boilerplate clauses. Many non-tax specific clauses impact tax. For example, retention of records, disclosure of confidential information, and the counterparts clause. Accordingly, one size does not fit all. The summary of all this is, please remember, sign in haste and repent at leisure. See your lawyer. That's all for now.
Hi, my name is Stephen Groves. I'm a director at Groves & Partners. We are expert valuers of businesses, companies, shares, intangible assets, as well as business transaction advisors. Thanks very much to Leigh for his informative presentation. As Leigh mentioned, today I'm going to talk about valuing intangible assets. This is a really interesting space, and I've noticed more and more activity has been occurring in this space in our practice. Hence, hopefully this presentation provides a lot of value to today's attendees. So what are intangible assets? Well, intangible assets by definition are assets that don't have physical substance, but assets that provide rights or economic benefits to their owners. So these assets can be created, they can be bought, they can be sold. They can be definite, like a brand name that a company might own for many years with no timeline to that ownership, so long as they do the right steps to protect that asset. Or they might be indefinite, things like customer contracts, which might run for, say, 5 years or a short period of time. There's a whole host of different examples of intangible assets, some which many attendees, I'm sure, are going to be familiar with, things like brands, patents, trademarks, but also things like customer relationships are also technically intangible assets or can be treated as intangible assets. What categories can intangible assets belong to? So very important and very useful when considering the valuation of intangible assets to understand what groups intangible assets can belong to. And broadly speaking, in the market, there's 5 different categories of intangible assets, which are often noted. And there's a further category, which is a very broad category, which very much relates to businesses. So the first category of intangible assets are marketing-related intangible assets. Now, these are assets that are primarily used in marketing or promotion of products or services. So think of things like trademarks, trade names, unique trade designs, or internet domain names. These all sit in the category of being marketing-related intangible assets. A second type of intangible assets is customer-related intangible assets. So these are things like customer lists, customer contracts, and contractual and non-contractual relationships with customers. There's a whole host of other examples which fit into this category. It's very common for businesses to hold customer-related intangible assets, whether they realise they hold them or not. A further type of intangible asset are artistic-related intangible assets. So these arise from the right to benefits from artistic works, so plays, books, films, music, and from non-contractual copyright protection. There was a very interesting case a couple of years back now that related purely to artistic-related intangible assets, in that there was a litigation matter in the States that related to the value of intangible assets, artistic-related intangible assets, held by the estate of Michael Jackson. So this is a really interesting area. It's normally a very specialised area. Sometimes there's market information out there that relates to the transaction of these assets, particularly rights to music. But oftentimes, given the nature of artistic-related intangible assets, such information is dubious to apply, because art, by its very nature, is often very unique. Another type of intangible asset is contract-related intangible assets. So contract-related tangible assets, this is in reference to the rights that arise from contractual agreements. So think of licensing and royalty agreements, broadcast rights, servicing contracts, employment contracts, and non-competition agreements. These are all contract-related intangible assets. Now, there can be some crossover between contract-related intangible assets and also customer-related intangible assets. So a customer contract, for example, but often contract-related intangible assets are very easily defined. So also an example of contract-related intangible assets, which is quite common, are natural resource rights. There's often a lot of contention over the value of those types of assets. The last main category of intangible assets are technology-based intangible assets. So think of software products, databases, designs, processes, recipes that are to do with technology. This is a really interesting space. Oftentimes, similar to many of the other forms of intangible assets, there's a lot of contention over the value of these types of assets. But sometimes there is very good market information to assist with valuing these assets. Other times, given the uniqueness of these assets, there isn't. In addition to these 5 main categories, there's a 6th type of intangible asset, which is very much broad-based, but particularly common in the business and commercial world, and that's goodwill. So often people will say, Stephen, what's goodwill? People think that goodwill is exactly the same as a business. Well, it's not exactly. So goodwill is defined as any future economic benefit arising from an interest in a business or from the use of a group of assets which has not separately been recognized as another asset. So what do we mean by that? Well, essentially, what that means is that the value of goodwill is typically measured as the residual amount remaining after the values of all other identifiable, tangible and intangible assets and monetary assets, once adjusted for actual or potential liabilities, are removed from the value of a business. So let's say, for example, we have a business and that business has motor vehicles worth $100,000. It has customer-related intangible assets worth $50,000, but the business as a whole is worth $200,000 without any liabilities. The goodwill is worth $50,000, being $200,000 less the $100,000 for the tangible assets and less the $50,000 for the customer intangible assets. So in the world of transactions, what does this mean? It generally means that goodwill is the excess of the price paid for a particular business over and above what all the other identifiable assets and liabilities are worth. I'm often asked why people may need to value intangible assets. There are a lot of reasons, and more we're finding people are looking to intangible asset valuations, particularly as part of transaction management. So business combinations, looking at impairment analysis, and as part of business acquisitions. Also, we see a lot of intangible asset valuations being done for tax reporting and compliance. In addition, litigation matters, particularly for technology-based intangible assets as part of technology-based businesses, is a really hot area, but lending requirements as well. Interestingly, there are some lenders in the market that will take a charge over intangible assets when lending money, and in doing so, those intangible assets will need to be valued. So now I'm going to talk a little bit about some of the methods that can be used for valuing intangible assets. There are a number of methods. I'm only going to talk about 3 methods, and I'm going to talk very simply and succinctly about those methods, but they're not the only 3 methods available to value intangible assets. Those methods that I'm going to discuss are the excess earnings method, particularly relevant when intangible assets are one part of a broader business. I'm going to talk about the relief from royalty method, which is a particularly common intangible asset valuation method that has good acceptance in courts and from financial institutions and from regulatory bodies like the tax office. And I'm going to also discuss market approaches to valuing intangible assets. So the excess earnings method, let's discuss this method first. So the excess earnings method is classified as an income valuation approach by the International Valuation Standards. So this means that, in essence, the method involves converting future cash flows to a current single value. So the excess earnings method applies a value to intangible assets after excluding the proportion of cash flows attributable to other assets which are required to generate those cash flows. This is particularly useful when valuing intangible assets that are part of a broader business. So, for example, if a particular customer contract helped a business generate income, what we would do as part of applying the excess earnings method is calculate the proportion of income of the business as a whole that is derived by direct reference to the business having that customer contract, and that income stream would be used as the basis for us making valuation calculations. The excess earnings method can be applied with reference to several periods of forecasted cash flow or a single period of forecasted cash flow. This is very similar to how in business valuations, we might sometimes take a set of projections for a business and use that as the basis for calculating the value of the business, or we might adopt a single earnings period result for a business and use that single earnings period result as the basis for calculating the value of the business. The excess earnings method essentially adopts this same philosophy. The second method that's a interesting method to discuss here, and it's interesting for a couple of reasons, but primarily because it has such wide acceptance in the market. It can be used for most intangible assets. It's accepted by the courts, by financial institutions, and by compliance authorities like the ATO. And that method's the relief from royalty method. So it's a very common method. And in applying the relief from royalty method, the value of an intangible asset is determined with reference to the value of the hypothetical royalty payments that will be saved from owning the subject asset instead of licensing the subject asset. So when applying the relief from royalty method, essentially what is done is we assume that the particular intangible asset for a moment might be licensed to a third party. If it can be, or if it can't be, we assume that it can be. We then calculate the market license fees for licensing that particular intangible asset, and we use that hypothetical license fee income stream as the basis for doing our valuation calculations. As part of doing this, typically those hypothetical license fees are projected into the future, and that hypothetical income stream is used as the basis for forming a valuation opinion. In a very similar manner to how income streams from a business might be projected into the future, with that being used as the basis of calculating the value of a business using methods like discounted cash flow. The last valuation approach that I'm going to touch on here and now are market approaches. There are a number of market approaches. In essence, each market approach, the aim of market approaches is to use market information as a reference point for understanding what the value of a subject intangible asset is. Market approaches are often quite reliable, but that assumes that there exists market information to reliably apply a market approach. And oftentimes intangible assets, as I've already noted, are particularly unique. And that means that often market information is not readily available, or for that matter, reliable with respect to the subject intangible asset. So under a market approach, the value of an intangible asset is in essence determined by reference to market activity. The most common example of this is that the value of an intangible asset is determined by reference to the transaction of similar or identical intangible assets in the market. This is very similar to how many people approach business valuation engagements, in the sense that business valuation engagements often look to the sale of similar businesses or identical businesses in the market and use data from those transactions to extrapolate the value of their subject asset. Typically, the market approach is applied by using the guideline transactions method, which is in essence an application of the method that I just discussed, which is looking to the market, finding market transaction information, and then applying that to the valuation. Market approaches are very commonly applied for some forms of intangible assets, but there's a limit to their effectiveness because of the difficulties in finding relevant market transaction information. And I'd like to thank everyone for attending today's webinar. And if you do have questions, I encourage you to reach out to me at your convenience. Thank you very much.